You know, when you think about the next global financial crisis, you're probably not thinking about Tokyo, right? You're thinking Wall Street, a housing bubble, something like that. But what if it's all starting with a quiet policy shift in Japan? Today, we're going to dig into this hidden connection, it's a wild one, between Japan's changing economy and the insane AI spending spree happening over in Silicon Valley. Let's connect the dots. All right, so for the last 30 years, global markets have been running on this secret fuel. It was cheap, it was everywhere, and it powered everything. Stock market booms, crazy venture capital deals, you name it. But here's the thing. That fuel is suddenly running out. So the big question we've got to ask is, what happens when the engine just sputters and dies? And that brings us to our first domino, and it's falling right in Japan. I mean, for an entire generation of investors, Japan has meant one thing and one thing only, a source of nearly free money. Well, that era, it's over. Done. Okay, to really get what's happening, you have to understand this idea of Japan being the world's low-interest anchor. Think of it like this. For decades, their own economy was kind of stagnant, right? Not much inflation. So their central bank just kept interest rates parked at basically zero. This made the Japanese yen the ultimate go-to currency to borrow for cheap. It was like a global credit card with a 0% introductory APR, forever. And that money funded investments all over the planet. But the Japan of the past? That's not the Japan we're seeing today. We are watching a fundamental tectonic shift. The old playbook of being super careful with spending, that's been thrown out the window. Now, under the Takaichi cabinet, it's all about aggressive government spending. There's a term for this, fiscal dominance. And it's basically when the government spends so much money that it forces the central bank to just keep printing more to cover the bills. You combine that with new inflation bubbling up, and suddenly the Bank of Japan has to do something it hasn't really done in our lifetimes, actually raise interest rates. And look, this isn't just some theory for a textbook. In early 2026, the markets got a huge shock. The yield on the 10-year Japanese government bond, they call it the JGB, it shot past 2.2%. Now that number might not sound like a lot, but for the bond market, this was an earthquake. It was this loud, flashing red light telling everyone the anchor is up. The era of free money is over, and the cost of borrowing is going up for everybody. So what happens when Japan's own interest rates start to look, well, good again? That's when the second domino tips over. We're talking about a massive wave of money, trillions of dollars, that starts heading back home to Japan. And the scale here, it's just mind-boggling. Japan is the world's biggest creditor nation. They hold over $7 trillion in net foreign assets. That is more than anyone else on the planet. So, when that much money decides to pack its bags and go home, it doesn't just make ripples, it creates tidal waves across every single market. From US government bonds to European stocks, everyone feels it. Let's put ourselves in the shoes of a big Japanese insurance company. It makes it super clear. For years, the smart play was to buy US bonds because, hey, the yield was higher. But now, trying to protect yourself from the yen swinging around is getting really expensive, and it's eating up all your profits. Then you look home, and you see you can buy a 30-year Japanese bond that pays a nice, safe 4% with absolutely zero currency risk. I mean, what are you going to do? It's a no-brainer. You sell your US stuff and bring that cash right back home. This also spells doom for one of the most famous and risky bets in all of finance for the last 30 years, the yen carry trade. You had hedge funds and traders borrowing billions and billions of cheap yen and then plowing that money into high-growth stuff like US tech stocks. It was a money machine. But as Japanese rates go up, the cost of that loan skyrockets. And unwinding those trades, it's not a gentle process. It can be sudden and it can be incredibly violent. Okay, now let's switch gears and look at our third domino. At first, this is going to feel totally unrelated, but stick with me. Just as Japan's river of cheap money is drying up, America's biggest tech companies are in the middle of the most enormous spending spree in human history. And it's all about one thing, AI. Just look at these numbers. The planned spending, just for 2026, it's insane. Amazon alone is planning to spend $200 billion. The rest of the so-called Magnificent Seven, another $300 billion. Even the company that makes the chips, TSMC, is dropping over $52 billion. They are all, and I mean all, betting the entire farm on winning this AI arms race. But here's the catch. Here is the hidden weakness in this whole plan. This historic spending isn't all coming from cash they have lying around. Not anymore. These companies are taking on mountains of debt to build all these data centers and buy up all the GPUs they can get their hands on. And what happens when you're loaded up with debt? You become super sensitive to rising interest rates, the very same interest rates that Japan is now pushing higher across the globe. And at the exact same time, there is another threat creeping in, a threat to the whole profit story of the AI boom. What if the very thing they're spending hundreds of billions on, this artificial intelligence, what if it just becomes cheap, a commodity? When powerful, super low-cost models started coming out of China, like DeepSeek V3, it raised this terrifying question for investors. This really gets to the heart of the profitability problem. It's simple, really. When a competitor can give you almost the same performance for a tiny fraction of the cost, we're talking 1/20th the price, that puts unbelievable pressure on your profit margins. How on earth do you justify spending $500 billion if the thing you're making has no pricing power? You can't just charge whatever you want anymore. So, this brings us to the fourth and final domino. This is where these two giant storylines, the end of cheap money from Japan and America's fragile, debt-fueled AI boom, this is where they slam right into each other. And it creates the perfect storm for what's called a global liquidity shock. And it's not just one problem. It's four huge forces all pulling in the same direction. Think of it like four giant drains being opened at the bottom of the global swimming pool of cash. You've got the US Fed still pulling money out with quantitative tightening. Now, the Bank of Japan is starting to do the same thing. At the same time, the US government is issuing a tidal wave of new debt that someone has to buy. And to top it all off, you have Japanese investors pulling their trillions back home. All four are sucking cash out of the system. Okay, so why does this cash drain hit AI stocks so hard? It's because of what they are in financial terms. They're called long-duration assets. What that really means is their crazy high stock prices aren't based on the money they're making today. Oh no, it's all based on the promise of giant profits years and years down the road. And the value of those far-off future profits is extremely sensitive to even tiny changes in interest rates today. Here's the easiest way to think about it. The interest rate on a super safe government bond, that's like the force of gravity for all other investments. As that rate goes up, gravity gets stronger. It exerts this powerful pull on all those high-flying stock prices, especially in tech, and just yanks them back down to earth. Japan, for 30 years, was basically an anti-gravity machine for the markets. And now, they've just switched it off. So with all these forces colliding, where does this all lead? How does this story end? Well, the analysis we're looking at lays out three very different possible futures for the global markets over the next couple of years. All right, let's break these down. Scenario A, the soft landing, has the highest probability, about 40%. This is the best-case scenario. It assumes Japan takes it slow with rate hikes and that the big tech companies' profits actually live up to all the hype. Scenario B is a cyclical correction. Think a 20 to 30% drop in tech stocks. That's if Japanese bond yields get a little more aggressive. But then there's Scenario C. It has a 25% chance, so 1 in 4, and it's a full-on systemic crisis. This is where Japanese yields spike, that whole yen carry trade collapses violently, and the entire financial system just freezes up. Okay, so you're probably wondering, what should I be watching to see which way this is going? Well, here are 4 key things to keep on your dashboard. First, that 10-year Japanese bond yield. If it breaks above 2.5%, that's a huge warning sign. Second, watch for big, sudden swings in the US dollar versus the Japanese yen exchange rate. That volatility is a sign of stress. Third, keep an eye on the actual cash flow being generated by the big tech companies. And finally, here's a really interesting one. Watch to see if Taiwanese insurers start selling their overseas assets. They're like the canary in the coal mine. If they start selling, it means the pressure is building. So what's the bottom line here? It's this. The world we knew is changing. That simple, almost foolproof, and incredibly profitable strategy that basically defined the last decade, borrow yen for free, buy NVIDIA, that whole game is probably over. And it's not coming back. You know, for 30 years, we've built our entire global economy on this foundation of cheap, easy money. That foundation is now cracking. Sure, it paid for incredible innovation, and it funded a ton of growth, but it also created these enormous hidden risks. And the biggest question it leaves us all with is, are we really, truly prepared for whatever comes next?